It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The statement above, one of the cornerstones of Warren's philosophy, encapsulates the wisdom that separates mediocre investors from the great masters. But what, after all, makes a business wonderful? How can one identify those exceptional companies capable of transforming wealth over time? Buffett is widely recognized for his unique ability to identify businesses with superior characteristics that enable consistent profits and growth over decades. This approach of selecting wonderful companies is not merely a matter of intuition, but a rigorous process grounded in solid, repeatable principles. When we talk about truly exceptional businesses, we refer to companies with durable competitive advantages, also known as moats. These companies have the capacity to overcome challenges and maintain market leadership while delivering robust financial returns. Recognizing such a business requires disciplined thinking, a deep understanding of business economics, and of course, a long-term vision. In this video, we will explore what it means for a business to be wonderful from Warren's perspective and how you can learn to identify these opportunities. We will dive into the characteristics that make a company unique, the signs indicating sustainable value, and how to avoid short-term traps that may seem promising but fail to stand the test of time. By the end, you will have a clear set of principles to begin building an investment portfolio that reflects his timeless wisdom. Warren has always been clear: to find a truly exceptional business, you need to look beyond the numbers and seek the fundamental qualities that make a company stand out. He focuses on three main pillars: durable competitive advantages, exceptional management, and earnings predictability. Let's explore these pillars in greater depth. One of Buffett's most well-known concepts is the moat, which can be understood as the trench that protects a company from competition. These advantages allow a company to maintain its relevance and profitability, even in competitive markets. There are different types of moats, such as strong brand. Companies like Coca-Cola, one of his favorites, have such powerful brands that consumers choose them even when cheaper alternatives are available. Operational efficiency. Businesses like Walmart or Costco can operate with thinner margins due to superior efficiency, keeping competitors at bay. Intellectual property. Pharmaceutical companies with exclusive patents or tech companies with protected innovations have obvious advantages. Economies of scale. When a company can produce on a large scale at a lower cost, it becomes unbeatable in pricing. Warren seeks companies with wide and growing moats, protecting them from external threats. Buffett always values leaders who think like owners. He looks for management teams that prioritize the sustainable growth of the business rather than impulsive decisions to please the short-term market. He examines the CEO's consistency in decision-making, the intelligent allocation of capital, whether reinvestment or dividend distribution, and transparency in their communications with shareholders. Companies led by ethical, visionary managers who deeply understand the business are the kind of investments he appreciates. A wonderful business not only generates profits, but does so consistently, even during times of crisis. He avoids companies with unpredictable cash flows, such as those in highly cyclical industries, e.g., commodities or emerging technologies without a clear track record. He prefers businesses that can confidently project their earnings for the next 10, 15, or 20 years, always asking himself, will this company still be operating dominantly in a decade? Will its products or services remain essential? Answering yes to these questions is a strong indicator of an exceptional business. Buffett doesn't buy stocks, he buys pieces of companies. This mindset helps avoid impulsive decisions. He asks himself if he would feel comfortable owning the entire business, not just for months, but for decades. Identifying exceptional businesses requires patience and research. He spends hours reading annual reports, understanding the company's operations, and analyzing its history before making a decision. Investing in truly exceptional businesses demands more than just identifying competitive advantages and quality management. It requires adopting a solid mindset that withstands market fluctuations and keeps the investor focused on the long term. Let's delve into how Warren evaluates businesses and the crucial role patience plays in his strategy. Over the years, Buffett developed a filter to understand valuations. Buffett doesn't just identify wonderful companies, he is also extremely cautious about the price he pays for them. Even the best company can be a bad investment if acquired at an exorbitant price. He uses the concept of a margin of safety, popularized by his mentor Benjamin Graham, to ensure that the investment provides protection against uncertainties. The main points of his evaluation process include return on capital. Exceptional companies generate high returns on invested capital without needing significant debt. Free cash flow. Buffett prefers businesses that generate consistent and growing free cash flow, allowing for reinvestment or dividend distribution. Price versus value. He focuses on calculating the intrinsic value of a business, the total value of its future profits discounted to the present. If the market price is significantly below this value, he considers buying. A clear example of this approach was his investment in the railroad industry. Warren acquired Burlington Northern Santa Fe when he identified that its price was below its intrinsic value. He understood that the railroad sector, while traditional, was essential to the economy, and BNSF had a clear competitive advantage. One of his most powerful secrets is patience. He believes the market often misprices assets in the short term, but eventually corrects these errors over the long term. This creates opportunities for investors willing to wait. Warren compares investing in stocks to planting trees. Just as a tree doesn't grow overnight, exceptional businesses need time to mature and reach their full potential. He often says that inactivity is a virtue in the world of investing. In the early 2000s, Buffett faced criticism for not investing heavily during the tech boom. He avoided these companies because he couldn't consistently predict their cash flows. When the bubble burst, he was applauded for his discipline. He understands that financial markets are driven by emotions, fear and greed. He advises, be greedy when others are fearful. During crises, prices fall, creating opportunities to buy exceptional companies at low prices. Be cautious. When others are greedy, during market euphoria, stocks tend to be overvalued, increasing risk. This approach was evident during the 2008 crisis. While many investors fled the market, Warren invested heavily in companies like Goldman Sachs and Bank of America, taking advantage of attractive prices. He is living proof that financial success is not achieved through luck, but through solid principles, patience, and discipline. His approach to recognizing truly exceptional businesses serves as a practical guide for anyone aiming to build wealth sustainably and securely. He often reminds us that investing doesn't need to be complicated. Identifying exceptional businesses and waiting patiently is a simple concept in theory. But it requires self-control, confidence, and study to execute effectively. He teaches that the true power of investing lies not in seeking quick profits, but in letting compound interest work in your favor. Buffett says, money is like a snowball. The important thing is to find wet snow and a long hill. That long hill is time. The earlier you start investing in solid companies and reinvesting your earnings, the greater your wealth will grow. One of Warren's most inspiring messages is that you don't need to be a genius to succeed as an investor. What matters is having the right mindset and the determination to follow solid principles. He is living proof that, with discipline, anyone can achieve a more secure and prosperous financial life. We conclude with one of his powerful reminders. It is not necessary to do extraordinary things to get extraordinary results. Start where you are. Identify companies you understand and believe in. Follow Buffett's principles, and you'll be on the right path to building your own financial success story. Now, it's your turn. Which companies do you believe have the potential to be wonderful? Take the first step today and start planting the seeds of your financial independence.